Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. In the last episode, we've been concentrating on various fund categories, but because mutual funds have a whole host of them, we have to dedicate another show, at least a part of it, as far as understanding some more categories. And joining me is Jayant, who was guiding you last episode as well. Well, thank you, Jayant. We'll be continuing with our discussion. We very briefly touched upon fund of funds, and let me, for the interest of a lot of viewers, just repeat. A fund of fund is basically a category in mutual fund which basically invests in other funds. So a fund collects the money from lots of investors and invests in different funds. Earlier, Jayant, in our previous episode, was talking about that this fund of fund category has not really caught on in India much. Also, the fact that there is very little advantage that has come in terms of the tax that is calculated, because tax is calculated as a debt category.
Yeah.
So you do not get the long-term capital gains tax benefit.
Yeah.
But coming back, stressing a little bit, and which I was also earlier mentioning, Jen, that if you are, say for example, there is a certain fund which is investing in a global fund, is that the only way that you can look at it, whether a fund of fund category is good or not? Because if it's a domestic fund, then you might as well do it directly in the fund and have a better tax advantage.
Yeah, in a sense that is true, but it's a convenient tool. So because for instance, if there's a fund of funds which invests in 5 different funds of the same fund house, in one stroke you get an exposure to 5. So that is, so people who want convenience, they may choose that. But it's at the cost of a higher expense ratio, because SEBI permits an additional expense ratio of 0.75% over and above what the underlying funds charge. But other than that, the international thing which you mentioned, they are more in the nature of feeder funds, where they just they take money and they invest internationally. That's a very good way to access those markets. But yeah, domestically, these FOFs are less compelling.
Okay, another category that we talk about is something called the index fund. Basically, it reflects completely what the particular index that it chooses does.
Yeah.
So, for example, I'm talking about say a Sensex index fund. So it has to reflect exactly what a Sensex is performing, or there can be also some variations, right?
There are some variations, but traditionally this is how it is, that the index fund will invest in the same constituents of the underlying index in the same proportion.
These are essentially the passive funds that we talk about when we say active versus passive, right?
Yeah.
Okay. So, some of the financial planners that I speak with talk about that index fund is, if you're looking at long-term investment, index fund is a good avenue to look at, because the risk is that much lesser. You're getting an equity exposure, but the risk is that much lesser. Would you agree with that?
I don't really think so. It's only that the costs are lesser, because in index funds, since they are not actively managed, you are able to get a lower cost exposure to equities as compared to an actively managed fund. Otherwise, the risk is not really very low. I mean, because here the risk is as much as any other any other regular diversified fund. Of course, the risk is much lower than a sector fund.
So, but otherwise, as far as it's not necessary that index funds are less riskier than...
No, not really, except that the fund manager risk is lower. Okay. For instance, if you have a staff fund manager of an active fund and suddenly that person leaves the fund, then there is a risk that the fund may underperform. So in index funds, that's not the case, because fund manager discretion is virtually zero. So the fund is on autopilot, so it goes on. So it's good, the risk is lower in that sense. But market risk has to be borne.
Okay. Now, as far as another category, which is perhaps the first step that most investors look at when they enter enter mutual funds, is ELSS, or the equity-linked savings schemes. Now, essentially, it has a time horizon of 3 years. Not time horizon, I should correct myself, but a lock-in period of 3 years, which is basically, and then you get tax benefit for every year or whatever you're investing in, right?
Yeah, that's right. Yeah. So these are regular diversified equity funds with the additional benefit of tax savings thrown in.
Okay. Now, given that we're talking about proposed DDC, it's not coming. How do you read ELSS funds? You can, because they were the perhaps only category or avenue through which you can be in equity market and save tax, because otherwise you will see there are only debt categories and investing in and you're getting tax benefits on them.
Yeah, so it is a disadvantage, but now you have the NPS option also, so where you can invest into index funds and get the tax benefit, although that's not caught on as such. But certainly ELSS coming out of the ambit is negative because the equity, this really was a good way for people to get into the equity markets. But
so while still there is certain clarity that needs to come in, at this point in time, what do you advise investors? Somebody who's wanting to save tax and go for equity, they should go ahead and as far as the ELSS category is concerned?
yeah, you could do a monthly SIP till March 31st, so for the next 5 odd months you could definitely do that. Beyond that it doesn't make much sense, because if you don't get the benefits, I mean there's no visibility right now, but if you're not getting the benefits, see, many of these funds have actually underperformed regular equity funds. So if you remove the tax benefit, then I don't think these are very attractive. So I guess that you should just take it as it comes. Right now just take a 5-month exposure and then see how things go.
As far as international funds are concerned, what kind of investor, firstly, how do international funds work? What are their tax implications, or how is the tax calculated?
There are 2 types of international funds. One is these feeder funds which you mentioned, where they will just take the money and put it there. For example, a DSP gold fund. So there the treatment is exactly similar to a debt fund, where even if you hold on beyond 1 year, you still have to pay tax at the rate of 10 or 20%. On the other hand, there are certain international funds which invest 65% of their corpus into Indian equities. For example, Fidelity has an international fund like that. So wherever this 65% threshold is met for Indian equities, then you have the same tax benefit as a regular diversified fund. So if you hold after 1 year, then you have to pay 0 tax. So there 35% only will be invested abroad and balance will be here. So these are the 2 main categories.
Okay. As what kind of investor should be looking at investing in an international fund, and why?
See, again, you should not get carried away by the flavor of the season, because like for instance gold is the thing, so people put in DSP gold. So but that's not the best way. These are supposed to give you diversification, but when you choose a fund, choose one which gives you real diversification. For example, a fund which invests in emerging markets. You have a lot of these international funds into emerging markets, Asian markets. They are not really that great, because the correlation between Indian indexes and those is more than 0.8, which is a high correlation. So you should choose things like, for example, I'm just giving names, I'm not recommending these. Say DWS Global Thematic, which invests only in European equities. Or say right now there are a couple of proposals that funds are made to SEBI, like the S&P 500 ETF. Some of these are good vehicles which give you real diversification where the correlation is less than say 0.5. So such things it makes sense, but even then go only.
If you could just for the benefit of our viewers, explain what does this correlation mean?
Correlation refers to if say our index moves up X%, how much does the other index move up? If the other index moves up equally as ours, then it doesn't make much sense, because basically you are investing, your risk is not reduced. Diversification is a means to reduce risk to some extent. So for that you have to invest in stocks or indexes or whatever which don't move in the same direction all the time. So the Dow or the S&P, if you have noticed, I mean last 1 year they have done very well, while we have gone nowhere. So such things will give you real diversification. But the Hang Seng and the BSE, Sensex or Nifty have moved more or less in line. So it doesn't make sense to put in a Hang Seng ETF, because they will also move in line with this. So our diversification not happening. So if you really want to diversify, choose things where the correlation is less. And now you have certain ways to check this out. For example, Value Research and all these websites, they do give you these correlations.
Okay. All right. Well, one thing that I also want to understand is that when you're talking about international funds, do you also run currency risk or you do not?
You do, because these are invested abroad. So, but the NAV will usually factor that in, because the NAV is converted into rupees every day. So that's why you will see that there are a lot of international funds now where you might be surprised that they haven't given the same returns as the say a Dow or an S&P. Because if they have gone up say by 25% over the last 1 year, these guys may have gone up by around 17-18%.
Okay.
So that is the currency difference.
Okay. Very quickly, now let me focus on exchange traded funds. You mentioned ETFs.
Yeah.
But let's simplify. What are exchange traded funds? How do they work?
They are similar to, most of these are index funds because they will track a particular index, except that the NAV is real time, and during the trading hours, say 9 to 3:30, you will find the price fluctuating every second. So you will get a chance to enter a particular index not at the day end NAV, but in real time.
In real time.
That is one advantage. But it's you should not get carried away only by that thing.
So ETFs are basically, we talk about something which is very commonly referred to right now as gold ETFs. So these ETFs are essentially that they reflect the gold prices, and they are listed listed in stock exchanges, so you can go and buy based on the real time of the prices.
Yeah, that's one thing. In addition, as compared to other index funds, they have a lower tracking error and lower expense ratio. So
well, I'm glad you mentioned that, because tracking error is something that we'll be addressing in our coming segment as far as busting some terms is concerned. Okay. But we'll take a short break, but when we return, we'll be talking about and taking your queries, and Jayant will be addressing that for you. Don't go anywhere.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome to Financial Planner. It's time that we take up your queries.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, Jayant, we have a query from Anish Goyal. He has a monthly income of about 40,000 rupees per month, but he has some property rental income coming in, which is about 1 lakh rupees per month through one of his commercial properties. Now he wants to do his financial planning. Tax saving is an important thing, and also wealth creation for him for the next decade, he says. At present, he has about 20,000 rupees as investment in infra tax saving bonds, of course saving tax already, 70,000 rupees in PPF. He has ULIP health insurance for 30,000 rupees. So investment in all these products add up to about 1,20,000 rupees, which is permissible. So I think as far as his tax issues are concerned, he's already taken into account. But like most investors do, the problem as far as the financial planning that I see is, in his case, is all about that it starts with tax planning. That's it.
Which is okay, not so bad, but he has to look at the other things also. Now the rental that he gets, that itself he can do a lot of tax planning there, because he is allowed many expenses which he can set off against this. For instance, depreciation on the property, any repairs that he undertakes, the collection fees, that is if he has employed somebody to do the collection work for this collecting rent. So there are several expenses under which he can reduce this income. So that's one tax planning tool. Second is, now this 40,000 I am presuming is salary income. He's not outlined what that is. But if it is, then anyway his EPF contribution, if any, that will go towards ATC also. Also these three things that he has mentioned, it's not technically correct, because this ULIP health insurance will actually be exempt under section 80D.
Yes, and not really ATC.
Yeah, and also if he is paying only for himself and his family, he'll only get a deduction of 15,000 on this. Only if he is including his parents who are above the age of 60 from this year. So then this 30,000 he'll get the full deduction, otherwise only 15. The infra bonds is under 80CCF, so that is correct. So, and his PPF is 70,000. So I think if he is not contributing to EPF, he has a 30,000 headroom here, which he can use. So I suggest that he, if it is not being consumed by say children's fees or some other eligible expense, then he should start an SIP into an ELSS, and do it only for these 4-5 months, because beyond that we don't know. So that will give him some equity exposure, and also don't ignore other things, like for instance his life insurance cover. That's very important.
That anyways will give him
yes, that also will give him the premium that he pays on that. So that's important, and also take cover for his property, adequate cover, because the commercial property. So insurance for that is also important.
Okay, so while this will give him entire protection in terms of tax and other protections are concerned, how about having contingency fund? What about the other financial planning issues that he needs to take care of?
Certainly, in the ladder he has to look at that first, because if he is not salaried, then he has to have higher contingency fund if his income is irregular. But even if he is salaried, 3 to 4 months of expenses he should set aside in a liquid fund. Or
isn't the regular monthly income providing him, the rental income that is coming in, providing him with that contingency?
Yeah, that is true. But again, that is subject to vagaries of the economy. Certainly it is good. For example, if he is injured tomorrow or he suffers an accident, that money will come in. So that itself is also part of the condition. If he is unable to set aside anything else, then that is good. But if he is unsure about if the tenancy agreement is only for 11 months and not a longer thing, so all those things are there. But as a general rule, it's better to set aside 3 to 4 months of expenses as in contingency, then look at your life cover, then look at the investments, like ELSS could form part of that, and then go into estate planning and all that. So, but the basic foundation is cash flow, like what you said, contingency, life cover, and then investments.
Well, as Jayant is talking, Anish, the important point here is that you will have to now look at the life cover, which is crucial for you. But however, if you look at it, just a little bit of, as far as your ULIP health insurance is concerned, clarification there that it wouldn't really be coming under 80cc, but the other 80D is what it will be coming under. So you can't calculate. So therefore, you could look at more tax saving, perhaps through ELSS, which will give you equity exposure and tax saving. Remember, there is some sort of change that is expected by the next financial year, so 5 months period that at least you can start investing in that. And you can also write into us for any other further query that you may have.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
We will take a short break here, but we'll be coming back and busting some terms for you.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. Earlier in the episode, we were talking about different fund categories, and one of the fund categories that we mentioned is index fund, something which reflects, or a fund which completely reflects the underlying index that you choose. So for example, when you're talking about a Sensex fund, or the index which is a Sensex 500 or something which basically reflects the Sensex 500, a sort of a mirrored returns, if I may say so, right?
Yeah.
And in that comes a tracking error, which very briefly Jayant mentioned before. So what is a tracking error? It is something that sometimes is a huge calculation that you do to figure out that it's, as far as index funds is concerned. If you could explain to our viewers.
Yeah, so basically when you invest in an index fund, you at least expect that you will earn as much as the index, because that's what the whole proposition is all about. But many a time the return that you get from the index fund is lower than what the index gives. So this difference is known as tracking error, because these funds are also known as tracker funds. So this term has come from that. So the error between the index return and your return, the difference, that is the error. Now this may happen due to 2-3 reasons. One is every index fund would like to keep certain cash to meet redemptions, so just like any regular fund would like to do. So that is one reason. Second is every index fund bears some expenses, whatever expense ratios are permissible. Right, currently it's up to 1.5%. So to that extent, if some index fund is maxing that ratio, so they will give you lower returns to that extent. And third is although it is passive, if there are certain changes which happen ongoing, like in the weightages, the fund manager is supposed to actively manage to that extent. For example, Reliance, it has fallen a lot over the last 2 years. So from around a 13% weightage, it has come down to 10%. So you got to actively manage at least that. So sell Reliance and substitute with something else, all that. So if you don't do it properly, then these 3 reasons could cause your return to be lower than the index.
Can an index fund give higher performance than the index itself?
It is possible in rare cases. In fact, Franklin India Index Fund, the Nifty option, has actually bettered the index for short periods. That again, that's where your cash will help you. For example, if you are having an outsized amount of cash with you, so as the index falls, you will fall less, simply because you are having, your exposure to the market is lower. But that's not the way investors look at it. I mean, they should earn returns in a better way.
And how do you get to know the tracking error? How do you find that out?
Yeah, actually, unfortunately, it's not publicized very much. In fact, on most of the websites, you will not get it. You will have to go to the individual funds fact sheet, which comes every month. So that is where tracking error is revealed. But I wish it were more popular. It's not disclosed
It's
very
something
easily.
which came in very clearly. So if you're looking at index fund, perhaps you may have to go to its fact sheet and see the kind of tracking error, because that sort of gives a difference between which fund is better and which is not, as Jayant had said. Well, thank you, Jayant, for joining us. Well, we'll be back next week with more on mutual funds. So don't go anywhere and keep watching this space.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.